Welcome to another episode of Market Mondays. I am so excited for us to be here on this channel. We're starting a new thing where we look at investment and things that you can do with your money to secure your financial future. Today, we're going to cover the 7 top ways to invest right now. The first one is a high yield savings account. These accounts are FDIC insured and are typically an online only option, which means you can access your funds online, then you can transfer them to anywhere that you need to, and some even allow you to withdraw from an ATM. Because there's less overhead on these accounts, banks can give you a better rate, which is the whole point of the accounts being online only. Now, this is a millennial or Gen Z type of savings accounts, so as you might imagine, you can't risk your money. It's just a savings account. Well, it can only disappear if you withdraw it to make a purchase because you really like that purse or those shoes, but honestly, the bank is not to blame for our spending habits. Rates do fluctuate. The risk here is that if the rate drops below inflation rate, then your money isn't compensating for the inflation rate, which means your money is not keeping up with the market. And that's the only discrepancy that is a real, let's say, risk for these types of accounts. Now, as always, do your research and make sure that the online account that you're investing in is FDIC insured. And a really good one to check out is Marcus by Goldman Sachs. The second way to invest your money is traditional certificates of deposit. Ever wonder how banks actually have the money to hand out loans? Well, they need people like you and I who are depositors who keep money in the bank to be able to loan that money out to others. Now, before you start panicking about what the bank is doing with your money, remember that certificates of deposit or CDs are FDIC insured. And unlike investing in stocks, they're considered safe. So the banks need you to deposit money in so they can hand out the loan to somebody else. In return, they give you a slightly higher percentage and you earn something on your investment. Now, they do require you to keep that investment with them for a certain amount of time. And oftentimes, if you walk into a bank and you ask them for their rates for CDs, they will give you a chart, and that chart will include months that you keep the money in, amounts, like a range of amounts that you can deposit, and the APR that you earn based on those two factors. Now, one thing that you have to take into account is that you do lock in that rate and you commit to it for the length of the term. So if a rate becomes, if a better rate becomes available, or if the rate changes, you can always get a new certificate of deposit, like an additional one, a secondary or tertiary one, but you can't change the rate of the one that you've signed into. So that's it for CDs. The third way to invest your money is in bonds. Unlike stocks, which give you partial ownership of a corporation, bonds are a loan from you to a company or a government. They pay a fixed rate over time and are great for low-risk investing. Short-term government bonds may be the best way for retirees or those who are looking to retire to invest majority of their money in. In a situation where you want to keep growing your money, but you're no longer willing to put your money into the stock market that is highly volatile, you are not looking for the gains that you would gain in the stock market, but you're also not risking the lows because you don't have time for those lows to fluctuate back to the level that you would expect the stock to be in. So in your 20s or early 30s, if you're investing, you may go with a more aggressive route and you may include more stocks rather than bonds in your portfolio. Now, a well-diversified portfolio will include some form of bonds as well. And that's because you don't want to just put all of your eggs into one basket. As the saying goes, you want to diversify. But also, if a person says, I'm going to go all in on stocks and I'm just going to pick my stocks, it's still stocks. So it's not FDIC insured, and there are some risks. We'll get to the gains and the risks in a second. Now with bonds, you get a fixed rate. It may be lower, but especially if you do the short-term government bonds, you know that your length of term is going to be short, so you'll get your money out of it fairly soon, and you're not jumping into the what ifs that come with any fluctuating economy. So everyone should have some bonds in their portfolio. In your 20s, you may have less. And when you're ready to retire or are retired already, that portfolio is going to look different. Like the wheels that they draw with a percentage of what they invest in. Like if you have investment from your bank and you have a portfolio in the bank, they will draw this percentage of this is how much you're putting into this category and this is how much you're putting into that category. So the two circles will look different because there are different needs in the portfolio. And this is why you should have a great financial advisor to walk you through the steps, understanding your needs and your wants and comparing it to what your options are. And this is when we get to stocks. Now, stocks are not all that bad, as I've been comparing them to bonds, but understandably, bonds have a much lower risk than stocks. But stocks have the opportunity to go up a lot more and gain in value than bonds. As I've previously said, stocks give you partial ownership in a company or corporation, and you generate a profit when the value of such corporation or company go up and appreciate. Now, stocks are a do it at your own risk type of thing, as they are not FDIC insured and values may fluctuate wildly. Now, here's a word of advice. If you've invested in a stock and your value dipped below your investment point, meaning now you're in the negative, consider holding long term. Evaluate if the company that you've invested in is viable enough to stay in business over the next foreseeable future in the long term, even if it's underperforming right now. If it is, you have nothing to worry about. Close those laptops, stop looking at the numbers, continue living your life, earn more money, save it up so you can invest in other categories that we're talking about right now. Diversify your portfolio with other sources of income from other investments and let it be. Hold on to it because stocks are a long-term type of thing. Number 5, index funds. When you invest in a stock, you're investing in a company. Chances are there are other companies out there doing business in the same category as yours. When you buy an index fund, you're buying a category or a basket of stocks designed to track a certain index. Essentially, you're investing into the category itself rather than any one company. Now, there are some great benefits to using index funds rather than stocks. Number 1 is the perceived safety in numbers. You're not putting all of your eggs into a basket, pardon the pun, but you're buying a basket of stocks and you're chasing the category itself. You're chasing the index instead of how well an individual company performs, which brings us to the next benefit, is that you don't have to spend countless hours reading over annual reports and income statement and balance sheets and financial ratios to try to find a strategy that suits that day or that week or that month, and you don't have to keep going over each individual company, because if you are investing and you're trying to diversify your portfolio, then as a responsible investor, you're going to research different companies and you're going to make sure that you're not just going all in to one thing. Well, an index fund gives you that safety where you're not constantly living and breathing this stuff. Unless it's your profession, then go ahead. If it's your hobby, go ahead. But then you'll understand what I'm saying even more so. There's a perceived safety in numbers thing. One thing to keep in mind, a couple of drawbacks, is that it is still a stock. An index fund performs like a stock. So when things appreciate, they can appreciate a lot faster and amazing gains may be seen, but also there are the risks. And just like when we talked about the stock market, I would really advise, if things are going down, don't pull out, evaluate the situation first and hold long term. So not FDIC insured, similar to stocks, except for you get a basket of stocks, you're chasing an index, you're buying into the category. And we get to talk about real estate. Number 6. Listen, welcome to my world. I could talk for hours about this, but for time's sake, I'm gonna try to keep it simple and short and sweet. If you want me to cover any one of these things at a greater length or a couple of these things, let me know in the comments below. Otherwise, let's get into it. Number 1, rental properties. This includes both short and long-term rentals. Unlike buying a house, which is still very important to have as a priority, rent is sort of a necessity. Keeping a roof over your head does not mean that you need to buy a house, or if you're not yet in a position to buy a house, you always start from rent, right? So this category is important. Watch my Turn Your Home into 2 series on Wednesdays, especially this Wednesday, where I take you through what it means to have a rental property, the difference between short and long term when you're purchasing. So what makes a good rental property, where to look, and how much you should expect in different market areas. Number 2, REIGs, or real estate investment groups. Now, it takes more capital to invest in, but may be well worth it. So here's how it looks like. A company looks for investors to help them build a set of apartment or condo complexes. And investors pitch in and say, this is a good idea. You found the right market, you found the great location, and you're handling your funds appropriately, so I'm going to invest. So investors purchase one or more of these units. Once the complexes are built and units are being rented out, investors get a steady stream of monthly income. The company operating the investment group does take a percentage of each month's rent, and that is because they have a big job to do. They not only make sure that everyone pays and they manage all of the units, they also take care of all of the maintenance requests and advertise all of the vacancies to keep things filled and running for the investors. Now, investors that have enough to invest in an REIG, it offers a truly hands-off experience. These things do not require you to know how to build. They do not require you to understand how to subdivide a property or how to apply for permits to build an apartment complex. You know that these people are well worth it because they're handling all of that for you. And in the contract that you get in the very beginning, you know exactly what you're getting into. You know how much percentage-wise the company requests for their works and services, and you know how much you're going to have. Now, you may not be 100% to the penny sure of how much rent will be, but you have a fair value of how the market's going to turn out. And think about it this way. From the beginning of the project, from the conceptual stage to the actual stage where people are starting to move in, the market adjusts. And as we've all seen, no matter if the market fluctuates, in the meantime, rates do end up going more because inflation is a reality, unfortunately. And you know that what you're buying into is a real estate investment. Real estate has some risk, but it is one of the most stable investments that you can make when we talk about the top 7 ways to invest your money in right now. Number 3, REITs, REITs, Real Estate Investment Trusts. Unlike the contract structure that we saw with the REIGs, REITs offer a stock version of what we just heard. So you're not investing in a certain apartment or condo complex in a certain area where you know this company is going to be handling it. You're investing in a stock option. Some benefits of REITs are that they require a lower capital to enter, that investors can invest in both commercial or residential opportunities, and they're more liquid because REITs are an exchange trade trust. For the REITs that are publicly traded, you should always make sure that the company is sustainable long term. Make sure their capital is big enough that they can diversify and invest in other real estate opportunities without having to dilute their shares. REIT dividends are taxed as ordinary income, and that percentage may be a lot higher than other investments. And recently, REITs got a really bad rap from fraudulent accounts or fraudulent investment opportunities. So always talk to a trusted financial advisor before making investments in REITs or anything else for that matter. Number 4, house flipping. Now this one is most complimentary for remodelers or seasoned investors in real estate. So if you are an investor and you want to not just rent out your properties, but you want to try your hand out at house flipping, if you're not a contractor, then find a trusted source. Find someone who is a contractor, who has a license, who's licensed and bonded, that you can get accurate numbers from, so that before you invest in one, you can see where the numbers stack up and you can see if it's going to be viable for you. Also, in parallel with using a contractor, have a trusted realtor, because when you connect these two together, you get the whole picture. Because a contractor can tell you this house has or doesn't have a structural issue, let's say, and a realtor can tell you this is a great market to invest in, and here are some distressed properties that are available in your area. Number 5, real estate crowdfunding. There are many platforms out there, many websites that pair investors with real estate developers. And the thought process or the idea is pretty easy. You take an investor, you take a developer, put them together, great idea. Of note, there are 2 main drawbacks. Number 1 is that there are high management fees on the accounts themselves. And number 2, your money will be illiquid or not liquid because you're investing in the developer and in their ability to develop some property. So when you sign up with them, their ability to get permits, to break ground, to build according to schedule, to build within the budget, all of that is under your investment. So you're holding on to it long term until the project is finished, and only when it is sold or rented out, which probably means they're selling it to another investment company, then and only then do you have your money back with the surplus, of course. Now, all of those 5 were under one category, real estate. Like I said, I can talk about this for hours, and for those that feel like I rushed through it, I apologize. Let me know in the comments so I can go back and talk about it some more, maybe with even some examples. And for those that are like, I'm more interested in other stuff, we're getting back into the list, jumping right back into number 7, cryptocurrency. A decentralized form of money, cryptocurrency is an online, a virtual type of currency that works with blockchain technology. One of the key benefits then is that it is not controlled by any government or entity, so it's free from manipulation, unlike regular paper money. We'll dive deeper into cryptocurrency, blockchain technology, and how investors are securing their money with crypto next week in part 2 of top 7 ways to invest in right now. So join us again next Monday. See you then.